the management of Capri Global. We have Rajesh Sharma, who's the MD at Capri Global, joining us this morning. A very good morning to you, Mr. Sharma. Thank you so much for joining us on ET Now. And let's talk about the quarter gone by. It's been an overall a mixed quarter for your company. The PAT was nearly flat, even after provisions saw a downtick of approximately 57% on a quarter-on-quarter basis. Could you help us understand what are the factors that actually led to such sort of a Q1 performance for your company?
So if we talk about Q1 performance, if you talk year on year, our AUM have grown about 41%, and quarter on quarter it has grown about 5%. Disbursement growth is up to 143%, and 7 billion, our AUM have grown to 69.8 consolidated basis. We have also expanded our branch network to about 26 branches we added this year. So there's a good expansion we have taken place to keeping in mind our ambitious growth plan for the next coming year.
All right, I take your point. Could you help us understand how demand has been, though, specifically in the MSME space, and geographically, are there any areas that stand out in terms of strength with respect to collection efficiency or disbursements?
So we have seen a very overall strong traction in the Indian macroeconomy, and the resultant there is a good upstick in the credit demand across all geography, whether it is MP, whether it is Rajasthan, whether it is Gujarat. We have seen a good demand, and that is the reason overall it has been a good quarter, despite that in lending business, the quarter one is always the lowest growth quarter as compared to all other quarter, and the March quarter is the highest growth quarter for every lending institution, whether it is a bank or whether it is NBFC housing finance. But we have seen a clear a rural and semi-urban area, there is a clear-cut upstick in the demand growth, and we see that coming year also going to remain a very good year for us.
Mr. Sharma, looking at the current macros, most of the NBFCs are expected to face margin pressure. Could you share with us your outlook for margins for Capri Global as well as for credit costs if possible?
So our net interest margin will remain in the range of about 7.5 to 8%. And if you talk about the credit costs, we have a restructured pool of about 175 crore rupees, and some of that pool will give rise to delinquency. For that, we are making adequate provisions and write-off as a more cautious approach. While the entire portfolio is secured by collateral property, and these write-off will not result into ultimate credit cost, but yes, for next 9 months, we will continue to write off all that beyond a particular aging in a particular area. So I think this quarter also we have written off about 24 crore rupees in total. And the next 2 to 3 quarters, we'll see a total write-off will be coming in the range of about, during the next 3 quarters, between 50 to 60 crore rupees. And this entire write-off, whatever happening, will not result into entire credit cost, but it will result into recovery of the same in next 12 to 18 months by exercising our SARFAESI provisions and other recovery proceedings. But we wanted to keep very cautious approach, and that is the result that we, beyond a particular aging, we declare any NPA, we will write it off. So that is the conservative approach we are following. But despite that, I think our growth momentum will continue, and our profitability will remain more or less on the guided path.
But on the asset quality front, is the company adequately placed in terms of provisioning, and which segments are you seeing recovering sooner?
So if we talk about our GNP on a consolidated basis, it has increased from 2.4% to 2.71%. Net NPA is still remain because of the high provisioning at 0.11%. Our provisioning coverage ratio is still 96.2%. So while asset quality has little moderated by about 30 basis. But if you look at the overall scenario, this is all secured lending, which is collateralized by at least in terms of MSME, the loan to value is about 2 times of the property we do have. In the home loan, we have about loan to value about 65%. So there's a good cushion available to us in the recovery. And this is the impact. What is we are seeing is the restructured pool, as I stated earlier. But this is all emerging and emanated from the COVID period. I don't think that in futuristic ways we have to worry about it. This is what we will continue to have our GNPA less than 3%, and I am not worried on that, being we are secured portfolio. Even the gold loan is going to be secured, and that is also going to contribute in the top line and the bottom line. So overall, we are quite optimistic about the growth, about our profitability, about the better continued net interest margin.
Mr. Sharma, housing finance actually constitutes about 27% of your AUM. We've seen the interest rates go higher. How are you actually witnessing demand momentum on back of that? Are you seeing increased inquiries for loans for own houses now? And also wanted to know, is the growth largely from tier 1 and 2 cities?
So as far as Capri's model is concerned, we are addressing to those customers who cannot get funding from the formal banking system because of their unorganized, no or proper adequate accounting and income groups. So these are the customers which are in the tier 2, tier 3 towns, and that is where our most of the branches are. We clearly see that there is a good demand from them, and even interest rate is going up. For these customers who are not very sensitive about 50 basis or 100 basis increase, but they are more vulnerable whether they get the money timely and to meet their growth. So, and their business depends not on return on equity but return on efforts. And so their 1% increase is not going to make a difference on their viability and their servicing the loan. So,
okay, thanks so much, Rajesh, for that. That